Hey folks, Joe DeSanto here. How are ya? Welcome to Wednesday morning. Hope you're doing well. Thanks for joining me in another video. In this video, I'm going to talk a little bit about investing in an economic downturn or even like a correction or recession or something like that. Some questions that arose were, is it good or bad to invest in a downturn? Is there something to be considered there if you're doing that? Could it go good? Could it go bad? And then some other similar questions are, what types of stocks, say, might be safer or more bulletproof in a downturn? What's dollar cost averaging, and does that play into the downturn scenario? And let's see, sorry, I'm reading my screen here. How should investors' age or time horizon affect it? Yeah, and so on. So anyway, I would say just in general, investing when the market is down is a great idea. We to some degree we look at the market in the long term as with an eye for historic performance, right? So overall, in the long run, the market has performed to the upside continuously for 100 years. Now, it's not to say there couldn't be some cataclysmic event that would, derail that for a very long period of time. But if you think about the most cataclysmic financial events of, say, the last 30 years, the Great Recession in 2008, related to the real estate market and so on, the COVID scenario, other just larger corrections, even going back to the 80s, 1987 Black Monday. All of those were very scary times, and people were pulling their money out of the market left and right, which obviously helps the market continue to go down in difficult scenarios. But the market rebounded and then blossomed. So if you could go back in time and buy every large correction dip, even long-term downward scenario like the real estate bust of 2008, where the market lost 60% of its value and pretty much didn't climb back to the same value for about 3 years, if you could go and buy that, you'd be a huge winner, right? So I'm always more afraid of buying into the market when it's at the top or when it's climbing feverishly. Now, people will tell you that you can also buy into the market when it's climbing feverishly, because in the long run, the market will again climb higher over time. Now, if you're buying into the market and it's growing or it's at its top, you possibly could be buying like a momentum play essentially. But inevitably, it's going to correct, and it might even correct to the tune of 20 to 30 to 40%. So at that moment, you're going to be angry with yourself. But in the long run, if you have the time, you're going to be fine and probably do well. But again, if you could go back and instead of buying, at that growth moment, that feverish new high moment, and go buy at that low moment, you will have made so much more money. So ultimately, I'm making the case for making sure you buy in downturns. Now, here's the problem. A lot of people are already invested in the market. They don't have a lot of cash or dry powder, as it's often called, or cash on the sidelines. So they have no ability to invest in the market in any significant way when it's down because their money's already in there. So that leads me into the dollar cost averaging question. Dollar cost averaging is essentially buying the market or buying stocks, or whether you're buying the market, buying individual stocks, whatever you're buying, and you buy on a consistent basis, whether it's up or down, from the last time you bought it. So say you put in $1,000 a month, every month for 5 years religiously from your paycheck. Sometimes you're buying it at its high, sometimes you're buying it at its low, and you are what's called dollar cost averaging your way into the market. so that you're catching it highs and lows and so on, and you're comfortably getting it at, like, I guess you could say maybe a nice medium. This is really the best thing to do over the long run. So if you're a young person or younger, I mean, even, 20s, 30s, 40s, and you can get a consistent investment going in the market from your paycheck or whatever, that is going to be like the most kind of foolproof way to invest. Sometimes what happens is people end up with a large chunk of money, like say from an inheritance, and they want to invest it. They don't want it to sit on the sideline, but the market's at an all-time high right now, or real time's at an all-time high right now. And I will admit that is a difficult scenario to invest in, because the truth is the market probably will correct at some point, and you might be frustrated by that. Or if you're later in life and you don't have a long enough time horizon, dropping a big chunk of money into the market at a high, frankly, in my opinion, can be dangerous. So, and overall, I would say, the market does pose risk for, in and out entry points. So a perfect example is during the Great Recession, if you happen to be looking at retirement right around 2008, you were 65 or 70, and you had all your money in the market, well, your money was worth about 60% less, by the end of that year, and you probably were putting off retirement. So that's just a fact of life. There's really not much you can do about that. But you can, well, actually, that's not true. You can't do much about that if you're deciding to be fully in the market at all times up into an older age. What you can do to avoid that is work on your asset allocation while you're getting older, or every year that you're getting older, so that you're building in more capital preservation into your asset allocation as you get closer to retirement. The rub of that is the more capital preservation you get in your portfolio, the less return you're getting, generally speaking, more pain, more gain. So you have to balance these things. And if you don't have a lot of money and you're kind of, in your 50s or 60s, you're trying to get it to grow, of course you want it to be in investments that possibly could give you more return. But an all stock portfolio comes with that risk that if you have a 1 or 2 year recession, downturn, something like that, you might be putting off retirement. So when someone says to you, what's your risk tolerance? I often say what that question means is, what is your willingness to keep working in a long and or prolonged, or sharp and or prolonged market downturn? That's really what risk tolerance is. So yeah, if you want to protect against that, you got to adjust your portfolio. You can't be really in an all-stock portfolio, I don't think, in your 50s, 60s, or 70s, maybe in your 50s, depending on how long you think you might be working, without just assuming that, come your retirement time, you might be in a dip, and you might not want to be cashing in your stocks. You might just have to put off retirement for a couple more years. Is it the end of the world? Probably not. So anyway, those are my thoughts there. I think, on the whole, when the market's down, if you got cash, I think you should be buying. That's what I try to do, though. In my case, often my money's invested in the market already, and I don't have tons of free cash myself when the market's down. So I try to keep a little bit of cash on the sideline for that purpose, to pick up, extra stock or extra whatever it is when that asset is down. All right, I will talk to you in the next video. Thanks so much.